Hey everyone, welcome back to Stock Starters, where we break down the big financial stories and help you understand what's driving stock performance. Today, we're focusing on a topic that's crucial for investors right now: Disney Plus subscriber growth and why it matters for the future of Disney's stock. Subscriber numbers can tell us a lot about a streaming service's growth potential, profitability, and competitive positioning. So, let's get into it. Before we dive into Disney Plus's subscriber growth, let's take a step back and talk about why this metric is so important for investors. When it comes to streaming services, the key to long-term success is building a large, loyal subscriber base that generates consistent revenue. For Disney, which has invested billions into Disney Plus, hitting subscriber milestones is a critical part of their strategy to drive future growth and profitability. Subscriber growth is more than just a vanity metric. It reflects how well Disney is competing in the crowded streaming landscape, which directly affects the company's overall performance. So, let's break it down. Why should investors care about the growth of Disney Plus? First, let's understand why subscriber growth is such an important indicator. In the streaming world, subscribers are the main source of revenue, especially for platforms like Disney Plus that rely on direct-to-consumer subscriptions. Disney's success in this area is pivotal for a few reasons. Disney Plus launched in November 2019, entering a market already dominated by heavy hitters like Netflix, Amazon Prime, and HBO Max. With billions of dollars spent on content, Disney needed to convince viewers to choose its platform over these established services. So, Disney Plus's growth is a direct reflection of how well the company is capturing market share. As of the latest earnings report, Disney Plus had reached 146 million subscribers globally. Impressive, but let's put that in perspective. Netflix, the leader in streaming, has over 230 million subscribers. The competition is fierce, and in this battle for attention and market share, every new subscriber counts. So what does subscriber growth really mean for Disney's bottom line? Well, a growing subscriber base is directly tied to increasing revenue. Disney Plus operates on a subscription model, meaning the more people sign up, the more money Disney makes. But the real magic happens when Disney can convert those subscribers into long-term profitable customers. For Disney Plus to be profitable, it needs to monetize its subscribers. Currently, Disney is investing heavily in content to keep users engaged and attract new subscribers, but there's still a big challenge in turning that investment into profit. Disney is betting on its growing library of original content. Think The Mandalorian, Loki, and WandaVision to keep people subscribed. Additionally, Disney is exploring ad-supported tiers which would allow them to generate revenue from users who can't afford the full subscription. This approach mirrors the model Hulu has been using, and it's proving successful for driving additional revenue. Another key factor in Disney Plus's growth is international expansion. While Disney Plus has been performing well in the US, its real potential lies in markets overseas. Disney has already launched Disney Plus in multiple countries, including key markets like India, Japan, and parts of Europe. As of the latest numbers, international subscribers make up a large portion of Disney Plus's total base. International markets offer the opportunity for huge growth, but they also come with challenges, like regional competition and differing content preferences. For investors, seeing Disney's success in these markets will be an important indicator of the company's ability to scale and capture market share globally. Now let's talk about competition. As we mentioned, Disney Plus isn't operating in a vacuum. There are a lot of other services out there vying for the same viewers. Netflix, Amazon Prime, Apple TV Plus, and even newer players like Peacock and HBO Max are all fighting for attention. For Disney Plus to continue growing, it needs to offer something unique. Luckily, Disney has the advantage of its powerful content library. Think Star Wars, Marvel, Pixar, and Disney Classics. But the competition is relentless, and Disney has to keep its offerings fresh and compelling to maintain its growth trajectory. The challenge will be balancing content investment with profitability. For investors, the ability of Disney Plus to maintain and grow its subscriber base while competing with these deep-pocketed rivals will be key. But here's the thing. Subscriber growth isn't all sunshine and rainbows. As Disney continues to expand its subscriber base, it also faces the challenge of turning those new customers into profit. For now, Disney Plus is still operating at a loss due to high content costs and ongoing investments in technology. While the company has stated that it plans to turn Disney Plus profitable by 2024, achieving that goal won't be easy. For investors, this means closely watching Disney Plus's progress in reducing its losses and increasing its profit margins. Subscriber growth is important, but the real question is, can Disney turn those new subscribers into a sustainable, profitable business? So what should investors be watching? Here are a few key things to keep an eye on. First, pay attention to Disney Plus's subscriber growth rate. A strong, consistent increase in subscribers is a sign that Disney is gaining traction and potentially capturing market share from competitors. Look at both US and international subscriber growth, as expansion in international markets could be a big driver of future growth. Second, keep an eye on profitability. As mentioned, Disney Plus is currently unprofitable, but that could change with the right balance of content investment and monetization strategies. A sustainable path to profitability will be crucial for long-term investor confidence. Finally, watch how Disney is managing its content and subscriber retention. With such a large content library, and so much invested in new shows and movies, the question is, will Disney be able to keep those subscribers coming back month after month? In summary, Disney Plus's subscriber growth is an essential metric for investors, as it directly correlates with future revenue and profitability. The company has done well to grow its subscriber base, but now the real challenge is monetizing those users and turning the platform into a profitable venture. With intense competition, high content costs, and the need for global expansion, Disney has its work cut out for it. However, if they can execute on their strategy and continue to grow their subscriber base, Disney Plus could become a major contributor to Disney's bottom line, and that's something investors will definitely be keeping an eye on. Thanks for joining us today. If you found this breakdown of Disney Plus's subscriber growth useful, be sure to like and subscribe to Stock Starters for more financial insights. Drop your thoughts in the comments. Do you think Disney Plus can turn profitable in the near future? Until next time, stay informed and keep growing your portfolio.